Peter, you've talked of 4 separate risks being inherent in the sale of swaps to SMEs. The third of those risks you've described as the credit risk. What is credit risk, Peter?
Credit risk is mismatching by size and strength. If a bank lends mortgages to people who have irregular work and poor credit records, that exposes the credit risk. In the finance world, it's called credit risk, or sometimes called counterparty risk.
How does credit risk apply to SMEs and the sale of swaps to them?
Well, when a bank sells you a swap, it values it on its professional system, Bloomberg, Reuters, or super derivatives.
Super derivatives? That sounds like something from DC Comics.
It's actually a real system, but they're all used by banks to value derivatives.
But what is the issue?
Well, the systems are all based on trading assuming a high level of creditworthiness. For example, a major bank should be AA rated. Ratings go down through AAA, down to the Bs, and then the Cs.
And what about SMEs?
They wouldn't get ratings, they're too small. The rating game is for hundreds of £1 million companies only.
Why should it affect us?
Well, when a bank sells a derivative to an SME, it will bundle them up, say 10 to 15 of them, and then do maybe a £10 million deal. Or it might just hold them on its books as an asset and value them accordingly.
I repeat the question. Why should it affect us?
It's a bit complicated, but the banks take extra lines of credit from an SME when they sell a swap, so you immediately become less creditworthy. You also become locked into that bank in a credit squeeze. But if the bank has valued your payments as if they are backed by a £100 million company and it hasn't reserved properly...
Now that sounds risky.
Yes. Now in theory, a bank should set aside enough money to allow for that risk. Indeed, the regulators set out requirements, which you can see in the bank's annual reports. But they didn't set aside enough for when interest rates fell fast, deep and long.
Then it was the bank that had a problem.
Yes, but so did SMEs. Post-2008, banks decided to squeeze and break up SMEs to solve their horrendous liquidity problems. It was smash for cash time. And who do you think came top of the list?
SMEs who had swaps.
Yes. By smashing these up, they both got hold of the assets and they took the credit risk off their books. If they smash up a variable loan borrower, they only help their liquidity problem.
Okay, I understand that. What about businesses who had tailored business loans?
The bank looks at the derivative part of the tailored business loan. They see a tailored business loan as a variable rate loan plus a fixed to floating derivative. If the derivative no longer has adequate support from your business, the risk will crystallise.
What about Funding Circle? They lend at fixed rates?
That's true, but their lenders come up with their own money and they don't worry about lending risks in the same way a bank has to. They accept that an SME will have ups and downs and put more store on a clean credit record.
And the government borrows at fixed rates?
Yes, with gilts. But the government can always print money or raise taxes to get out of trouble. And large corporates who also issue fixed rate loans, sometimes called debentures, their borrowing and lending is fully supervised in a professional market.
Okay, I think that's enough on credit risk. What's next?
Operational risk, Jeremy. A bit easier to understand.